We just had a blowout jobs report, which you would think would be amazing for the stock market, but it is getting absolutely monkey hammered today. Take a look at the stock market map here. We are seeing red almost all across the board. Now, I am going to show you one section of the market that is really benefiting today, but overall, all you see is big, ugly, nasty red candles. And what in the wide world of sports is happening? Wouldn't a fantastic blowout jobs report mean that the market's super happy and healthy? Actually not. So let's break this down. So the May non-farm payrolls was 172,000 growth versus 88,000 growth expected. Okay. And they even revised up the previous month. So overall, this sounds great, right? Fantastic news. It's getting tougher to get a clean picture of the US labor market, though. Here's a new survey showing that the share of US small businesses planning new hires or trying to fill jobs has actually fallen to a 6-year low. So small businesses planning to hire people is going down and down and down. This is so weird, but we just hit all-time highs on, not all-time highs, but we just had a blowout jobs report. What's going on over here? So additionally, meanwhile, earlier this week, the number of job openings surged to the highest level in almost 2 years. Okay, hang on. We got some real disconnects here. We got the highest level of job openings. We've got significantly higher number of non-farm payroll growth, and yet the market is getting destroyed this morning. Why would this be happening? Why would this be happening? The U.S. economy adds 172,000 jobs in May. Unemployment rate was 4.3, in line with expectations of 4.3. This marks the second strongest U.S. jobs report in 13 months. But you know what's not happy about it this morning? Bond yields. Bond yields are not happy about it at all. In fact, when we look at the bond yields, 2-year just exploded higher. The 10-year also moving higher. Okay, why would this happen? Well, I asked ChatGPT because I don't want to get it wrong. Why would the 10 and 2-year yields spike if the jobs report came out with better than expected numbers, right? Now, when these go up, that puts pressure on the markets, okay? There is a correlation here. When yields go up, it hurts the market. The market's down over 1% this morning right now. The SPY is now down over 1%. The Nasdaq is down roughly 2%, okay? Why would this happen? Because a hotter jobs report tells the bond market the economy is not slowing enough, so the Fed has less reason to cut rates and may even need to stay restrictive longer. More hires equals stronger labor demand. Strong labor market means inflation risk stays alive. So what does this mean to you? Right. What does this mean to you? If rates go up, that pushes the stock prices down in a nutshell. It's not a perfect correlation, but in that way. When the job market's going up, that puts pressure on inflation because there's more employed workers. That mean more income out in the ecosphere, more consumer demand, and potentially more wage pressure, which pushes inflation up higher, which means the Fed has to offset that by raising the overnight rates. This is high finance, and this can be absolutely difficult to understand. But how about we break it down in a more simpler way, right? Let's break it down in a more simpler way, because we've been talking about a big warning in the market. We've had this buy signal in place for a long time now. The buy signal on the SPY has been in effect since April 9th and has run like crazy. But the greed has fallen off a cliff and has been falling since mid-May. Same thing on the Nasdaq. It's been running for months, but the greed has been falling since mid-May. One thing that I've really picked up on is the fact that market breadth, while it was increasing, has slowed down significantly. It's still not crossed over bearishly just yet, but market breadth is pulling in, is definitely pulling in. Now, on the whole, who cares about market breadth? Who cares about market breadth? This is showing you where opportunities are lying. And you probably got really used to the fact that the tech sector was the greatest sector of all time, right? All you got to do is buy Micron or buy SanDisk or buy anything that has anything to do with semiconductors, and you're going to have more money at the end of the day, right? That's usually how it went. That's not the case anymore. In fact, if we take a look at the tech sector right now, it's the worst performing group today. It's being hit the hardest amongst everybody in the entire market. And if you want to take this a step further, how about the Mag 7 stocks? How about the Mag 7 stocks? Remember, these were the easy buys. These are the ones that everybody needs to hold in their portfolio forever. All but one. So 6 out of 7 are sitting on sell signals. 6 out of 7 are pushing into the fear zone. Nvidia is actually in the fearful zone right now at 45 on the fear and greed scale and has had a sell signal since May 22nd. Apple just got a sell signal yesterday. Had a big, beautiful over 20% run here between the buy signal and the sell signal, but it is now in a sell signal position. It's time to get out of the way. And that was before this morning, right? This morning, this one's up a little bitty baby bit, where the rest of these big guys are really suffering. Google, sell signal came almost at the very top on May 14th, and it's been falling ever since then. Google is down. How much is Google down this morning? Not too bad, 48 basis points. Nvidia is the one that's taking it on the chin today, really. The next one, the Mag 7, Amazon, sell signal came on May 12th. Okay. Do you see a pattern here, right? All these formerly easy names to make money in are leading down. So if the leaders are leading down, are you really sure that this is going to be the best, easiest market ever of all time? And this comes into the same picture of the fact that the jobs market blew up, was amazing with the jobs report, yet the market's tanking. And it's due to rates, and it's due to these guys right here that are really suffering this morning when rates are going up. And you've got Meta sitting on a sell signal as well. Then you've got Tesla sitting on a sell signal as well. And the only one of the 7 with the buy signal is Microsoft, but it looks like it's going to turn into a gap and crap. Microsoft is down another 50 basis points this morning. So this sector at one point in time was the easy money, but we ain't there anymore. We ain't there anymore. Now, remember, when the market goes down and money starts rotating, where does it rotate to? Staples and utilities. Those are our flight to safety assets. Those are our flight to safety sectors. And looking at this list over here, consumer defensive is the best winner on the day. The best winner on the day so far is consumer defensive. Consumer defensive can also be called staples. So you may hear me say one or the other. They're the same thing. So looking at the staples here, it's on the opposite end of the tech sector. The tech sector, it's cooked right now. Consumer defensive, staples. Oh, hang on. Now we're talking. Now we're talking. Coming over here to the sectors that have bullish crossovers, the tech is definitely weakening. The tech is definitely weakening, while staples has actually been holding flat in the number of buy signals, and I would imagine starting to run here in just a minute. So let's dive deeper into the staples and see what's going on over here. Grocery stores. This makes sense. Now, I've been beating this drum for most of this week that grocery stores, discount stores, the staple sector in general is where money is rotating to. And that's why God mode is so cool. That's why we're building this into OVTLYR. So you'll be able to see a top-down view of, wait a minute, the tech sector actually isn't doing all that great. Where's money going? Oh, the defensive sector, the consumer staples. Wait a minute, maybe I need to be putting my money over there. Okay. Big winner on the day in this sector, in this industry, is grocery stores. And if we jump into the grocery stores, there's 3 that are over $10 with over a million average daily shares. You've got Kroger, Sprouts, and Albertsons. Each one of these is up over 2% this morning. We did an entire video on these 3 stocks. Be sure you watch that video. We did a full breakdown on them. Okay. Now, where are these guys in the S&P 500 map? Can you even see them? No, because they're over here. They're itty bitty baby guys. Let me see if I can find it real quick. There's Kroger. Look how tiny Kroger is. I don't know where Sprouts and Albertsons have gone off to. They're somewhere over here. They're so itty bitty baby, I can't even see them. Right? This area, the consumer defensive, the staples, is where money's rotating to. They're taking their money out of these big guys and they're rotating into these itty bitty baby boys because these are the safety stocks. We always are going to need Kroger, right? Kroger may not be your favorite place. Maybe Aldi's your favorite place. Maybe you get your groceries at Walmart. Maybe you go to H-E-B like I do. I love H-E-B. But at the end of the day, Kroger has been pushed down for a long time. It's been beat up for ages, and justifiably so. Why does anybody need grocery stores when you got AI? AI is going to put grocery stores out of business. I kid you not. This is the narrative. This is how people actually think. Why do I need to invest in grocery stores when I can just invest in AI? It's the future. The reason that these stocks perform well when the high-flying tech stocks start going down is because people realize, oh, wait a minute, I actually do need to go to Kroger. In fact, I need to pick up some milk and some bread. and some other doomsday supplies, because when the tech sector starts to go down, everything is terrible. Everything is awful. And so we see the sell signal is still in place on Kroger, but you can see it has bottomed on price. Let's go to Kroger real quick. It has bottomed on price and is now starting to push back up. Coincidentally, ironically, right at this level of support. Who would have thought? Right at this level of support, Kroger starts to act right. Kroger starts to act right. So where I'm going with that is Kroger's not ready to buy yet, but it's getting close, right? This sector, this industry, the grocery stores, needs to be on your radar. So take a look at Kroger, another stock, Albertsons, right? Albertsons, ACI, another stock hit a bottom and is pushing up. And lastly, how about Sprouts? Let's see if it's hit a bottom and started pushing up, SFM. Right? Now, I am no magical fortune teller. I can't see the future, right? I don't know if this is going to continue. But when you look at the market as a whole, you're looking at rates, you're looking at jobs, you're looking at the trend of the market, you're looking at the fact that, wait a minute, there's definitely some rotation under the surface. Where's money going? Money's going into the consumer defensives, the staple sector. And that is a big telltale warning. And in fact, we even had a video where we talked about even more warnings. And you can watch this right here. This is the exact moment the stock market rally becomes dangerous. And we are right at that precipice. So be sure to watch that. Be sure to subscribe. And I'll see you in the next video.